Welcome. Today's video is going to be on the balance sheet and how to prepare it. Please note on this video, anything in green or blue is note for your notes only. Everything in black is what should be on a balance sheet, properly prepared. So let's look at today's balance sheet for X company. Again, when we do a financial statement, name of the company, name of the statement, and either the period of time or the point in time. A balance sheet is like a photograph of the business at a point in time. So there are two things that we want, what we got and how we got it. That's the purpose of a balance sheet, is to show what we got, which are assets, and how we got it, through borrowing from others or through our own investment in the business. First thing we're going to look at is the assets, which is what we got. Is there an order to the assets? Yes. Do I expect you to know that order at a future point in time, probably a couple modules from now? Yes. But right now, no. I want you to get an idea where things go and try and do your best at this point in time. So, assets. Cash generally goes first, so the $5,000 with a dollar sign. Accounts receivable will go second. What is an accounts receivable? That's people who have charged something on their account, so they bought something from you, like on a Visa. They owe you money, and they will pay you at some point in the near future. So that is an accounts receivable. Money will come to you at some point in the near future. Inventory, office supplies, prepaid insurance, we'll talk more about that later. These are commonly called current assets. Those assets generally turn into cash within a year. Fixed assets, land, buildings, and equipment are commonly in that order, although they don't need to be. They're called fixed assets because they tend to remain in the business for a period of time, generally a number of years. If we were to sell them or dispose of them, we might not be in business. So it's very important we have those fixed assets. So we run up our total assets, $40,000 with a dollar sign and two lines. That indicates that what we got, the assets, the left side of the equation, is done. Now we need to figure out, well, how did we get it? We got it through borrowing money from others, liabilities, or through our own investment in the business owner's equity. Like assets, liabilities generally are also broken into current and long-term. We'll see that later in the course. Right now, let's not worry so much about that. Accounts payable generally is the first one with a dollar sign. In this case, $1,000. What does accounts payable mean? Well, basically it's where you've borrowed money from another business and you owe them that money at some point in the near future. So it's kind of like the opposite of an accounts receivable. So, for example, I go and buy some office supplies, I charge it on my Visa, and yes, I'll pay a company office supplies maybe in 30 days. So that would be an accounts payable. Sometimes the accounts payable can't be paid, or the vendor wants to have you sign a document, basically an IOU, and saying that you will pay them 30, 60, 90 days down the road at a certain percentage of interest. That's what a notes payable is an IOU. And then taxes payable. They are generally in that order because accounts payable is owed to other businesses. That generally is paid first by most businesses. Total liabilities, $3,000 in this case. Owner's equity, the name of the person, comma, capital. In this case, J. Doe has $37,000 of his own investment in the business over time. Draw a line, total liabilities and owner's equity, $40,000, two lines. We want to make sure that what we got, $40,000, equals to how we got it, $40,000, and it does. So we are in balance. Never assume anything in accounting. Always double check. What does this balance sheet show me? Well, it does show me one thing. Liabilities are $3,000 out of total equity of $40,000, meaning that in this case, this business is very well capitalized by the owners. So they're not in great risk of going out of business because the owners have put a lot of their own money into the business. And the owners probably could borrow at a fairly reasonable rate. However, if this instead of $3,000 were $30,000, and this were $10,000, then who owns the business? The creditors do. And do you expect the bank to give you a loan? Probably not. So it does say something about the business and its ability to operate into the future. So let's rehash. Again, the name of the company, X company, the name of the statement balance sheet, June 30th, the date and time. Assets, what we got, generally in this order: cash, receivables, inventory, supplies, prepaid insurance, land, buildings, and equipment. Give us a total. Liabilities, something payable, as you notice. So accounts, notes, taxes payable gives us total liabilities, owner's equity, JDO capital, and in total liabilities and owner's equity. Where are you likely to make mistakes? Putting revenue as an asset, putting expenses as a liability. Where else are you likely to make a mistake? Taking the receivables and putting them on the income statement as a revenue, taking the payables and putting them on the income statement as an expense. I hope that helps you in preparation of the balance sheet. I look forward to seeing you on the next video.